2 to 3 years ago, e-commerce deals were hot as shit, and now they're cold as snot or something like that. Why? Why? Or is that not the case? E-commerce was like super hot. Everybody was paying any amount of valuation.
It's the case.
What?
It's the case. It's true. It's very true.
Right.
It's very true.
And now cold is fucking like why?
Who
is wrong?
It's the polar vortex right now.
Yeah,
of e-commerce. Yeah, so I think part of it is if you and you guys.
By the way, Stephanie Palmeri, SoftTech VC.
Hi. So thank you. So yeah, I mean, I think if you look at it, you have a bunch of companies that raised a lot of capital and haven't. Some of them have stumbled, right? And that kind of upsets the balance. There's not been a lot of exits at the later stage, if any. And so Zero. Right, Zulily, that's true. We've had one, and I think that's a good sign.
I'll take that one.
Yeah, I'll take one too. But I mean, at the end of the day, there's a lot of wait and see attitude, I think, at the upper levels, and that just trickles down. And so if you don't have the later stage funding and they're capital intensive businesses to build, it's much harder to put even early dollars in if you don't think there's going to be a pipeline of funding that comes later, because it takes a lot of fucking money.
And so definitely capital intensive, but that's always been true. And now it's like, oh, e-commerce sucks. Everything in e-commerce is terrible. Nobody's going to ever buy anything online anymore.
So I'll add something to what Steph said, which I think is totally right, which is it's also relative
Aileen Lee, Cowboy Ventures.
It's also relative to what else is going on in the market, right? I mean, right now, if you look at valuations for other stuff, like enterprise or audience-based businesses, like the multiples that you get on those companies as an investor are kind of ridiculous, right? And whereas like e-commerce does trade when it does go public more like traditional retail than it does like SaaS. And so you're looking at 1 to 5 times revenues, not 10 to 50 times revenues in terms of exits. And so I also think that like Steph said, a lot of people invested in e-commerce companies at valuations that were too high. And they have to, in the traditional venture model, each partner gets to make 1 or 2 investments a year. And they're trying to build a diverse portfolio.
Unless you work for someone that
we're not like that. We're not traditional. You've got the non-traditional crew. But in the traditional world where you eventually do have to generally raise from for your follow-on rounds, those people are trying to build a diverse portfolio of a bunch of different things. They don't want to just be long one sector, and they probably made their commerce investments 2 or 3 years ago. And so when they're looking at their portfolio, they probably don't want to add new commerce companies to it, and also they're probably getting shit from their partners for the ones they already made. And so it has to be really great for them to be willing to go to the table and say this is the e-commerce deal that we should do.
And I would definitely add to that
Eurie Kim Forerunner.
Sorry, Eurie. The strong opportunities are still getting funded, and they're actually getting funded at high multiples, sadly, for us. And the thing is that the bar is actually just moving and constantly moving, and the teams that are able to exceed expectations are the ones that everybody wants to invest in. And I think if you guys were all here in the morning, Andy Dunn from Bonobos was talking about how there was a time where people thought you could build an e-commerce company really quickly, and it's not true. It takes 10 years. And so I think over the last...
It doesn't really take 10 years. Come on. 10 years?
10 years to what?
Especially if you're not... if you're Flash, it's different.
10 years to
I know,
I think he's trying to keep
$1 billion
competition.
IPO, some monetization. I mean, maybe not Zulily, but it takes a long time. And I think over the last couple of years, people didn't know what it took, and so they just were trying to put some bets out there, and they were trying to test things out. But now I think it's pretty clear what makes a really strong brand. I mean, we heard Tim from Warby Parker talking about all of their branding exercises, and what that reminds me of is there's no one silver bullet, right? It's like it's a continual effort of figuring out who your customer is and what they need and how to satisfy them.
So Mike Jones, science. He startled me with science. So you guys are doubling down on e-commerce pretty hard. It's pretty much all you do, right?
It's one of 3 things that
one
we
of
do.
3 things. Okay.
But yes, but we do a lot of commerce for sure.
Okay, and so you're obviously pretty bullish on it.
We are.
Do you see any challenges in getting downstream capital from companies that you guys get started?
Well, I think 6 months ago there was this hangover moment from the Just Fab Shoe Dazzle combo. And then there were some big deals in New York that also imploded about 6 months ago that were like, $70, $100 million in capital, and then the companies fundamentally disappeared. So 6 months ago there was this, I think, this dead spot. I think now we actually haven't. I feel like venture has kind of lost that. They've forgotten that memory. And so it's a short memory in venture. And so I think that now there's a lot more interest. And I also think that I feel like e-commerce is actually the wrong category to be talking about. There's there's online retail and then there's brand development. And I think that, at least I feel like the opportunities in brand development that gets introduced online and then becomes global brands, I think it's much harder to play in the online retail space. Do you ladies agree with that?
I think most of the
Ladies?
interesting things we're seeing are coming across as building brands. And the one thing I'd add is, a year, 2 years ago, if you're doing 10K a month in revenue, you probably had enough traction to raise a seed investment. And now companies are doing 10x that with 100K in revenue a month, million or more dollar run rate, and they're just going out to raise their seeds. So there's a lot more discipline coming into even the early stage companies, and I don't think that's a bad thing. I think that's a good thing.
So one thing that I always try and bring to the conversation that I think most people don't talk about is margin matters and timing of revenue and expense matters a lot for various e-commerce companies and channels for marketing as well. But are there efficiencies to be gained? Are there certain types of e-commerce businesses that are easier to start?
For sure. And I think, at this point, we've seen so many of these kind of micro brand launches online. There's 3 or 4 metrics where if they're above a certain threshold, it'll be a great business. And if it's not, it just won't work. Margin is definitely the first one. Yeah.
And you guys have actually launched several brands that are very, very niche specific categories, almost like one product companies.
We have a candle company that has probably 2 SKUs. And we're at the point now where I don't even like to bring stuff out to venture until it's past $300,000 or $500,000 a month in revenue, because we found that it's hard to get the first 50. After the first 50, you can kind of get it to the next 250, but getting from 250 to 500 is hard. And we want to make sure that our companies will really get out there. Otherwise, I think it's a big problem. And to your point, cash is a big, big, big issue. If you remember, in commerce, you're dealing with 2 aspects of negative working capital. A, you're typically buying your inventory up front, and B, you're typically buying your customers up front, whether it's through marketing or product or however you're doing it. And so you have 2 aspects of a lot of cash that moves at any one period of time. And that's one too many for most people. And you also have a lot of founders that, a lot of technology founders are frankly not financially savvy, and they step into these very heavy cash management businesses. And we've seen companies that die not because they're not fundamentally good models or fundamentally good products or fundamentally good founders. It's just because the founders could not get their hands on the financial needs of the business and stay in front of the problem.
Do you folks look at unit economics a lot? And I guess for companies that are at least break even on the unit economics, is venture debt an interesting part of the financing equation?
It's a very interesting part.
Yes.
How
come we don't hear about that very much?
It's funny. Actually, I think it's a lot of times I think I've seen companies try to raise it too late. If you need to raise it, you're raising it too late. The right time to do it is when you close that seed round, while you still have, your ideally 2 to 3 million minimum in the bank for a seed stage e-commerce. I'd say almost 4 would be the right number. But back that up with venture debt, and then use the venture debt for your working capital needs, and put the equity towards people and towards acquiring customers.
So who are venture debt providers that people should talk to?
Silicon Valley Bank a sponsor today?
we don't have
Silicon
to
Valley,
only mention
No, but
sponsors.
Silicon Valley Bank is the one that most of WTI. Yep.
WTI and Silicon Valley Bank.
Yep.
Anybody else?
Square One. Yeah.
FastPay.
Yeah. There's a lot of them, and as long as you have a nice, strong syndicate of investors, that money is there because there's a trust with the investors as well.
But it does add a level of complexity you should be aware of. One perspective could be that, listen, if you can go raise the $3 or $4 million seed round, then you should be strong enough to operate the company and not necessarily have to leverage debt. Leverage debt, you're buying time, and most founding teams aren't sophisticated enough to really understand how to use debt. So I think it's nice. I'm happy to use it when we get it, but personally, you could take a very opposite view and say it's a bad discipline, and you should get way further before you really start leveraging debt, because most startups don't know how to appropriately use it as a vehicle.
So explain that, unbundle that a second. So why am I diluting myself more on diluting myself more with equity if I could backfill that with debt when my unit economics are positive?
Well, the perspective would be that if you're coming to the end of your equity raise and the company isn't strong enough to support another equity raise, so now you're eating into a debt line in order to keep...
No, I'm just saying when I'm raising. Suppose that I can raise 3 million, 4 million, 5 million. Mm-hmm. Why take 5 million and take an extra 5% equity hit when I could raise 3.5 million and raise the other 1.5 in venture debt and take no equity hit on that venture debt? Because
I think that if you can raise 3... you should be able to get to a traction point after you've burned 2.25 to be able to get a much larger valuation. I'm not a big believer that the extra runway that debt will get you, because they probably won't give you $1 million, they'll probably give you $500,000 or $250,000.
Okay.
And I don't know if it'll get you far enough that will drastically change the next round.
Okay.
Personally.
Fair enough. Shit in a box.
Can I jump into
Sorry,
something that I'm just still thinking about what you said about and what we're talking about, this polar vortex in commerce?
Yeah.
I think it's true for only some sectors right now. I actually think that there are some things that are going on that are actually raising a lot of money. Marketplaces, businesses that are basically commerce that don't have a lot of don't have long lead time inventory. Like if you look at the food sector right now, right? There are a ton of companies in food. They're like delivering, they're FedExing ingredients, they're dropping off cooked meals, there's crowdsourced meals, they're raising a bunch of money.
Are these fundamentally different businesses, or are we just saying marketplaces are sexy and e-commerce
No,
isn't?
I think of commerce very broadly, which is like there's a transaction with a consumer, right? Airbnb is a commerce company. Uber is a commerce company, right? And a lot of these companies that don't have inventory and are more like marketplaces are being and new ones that have almost no traction are actually not having a hard time raising money.
Right. So I think what we're saying is e-commerce businesses with thin margins and timing of capital needs are a pain in the butt, and we don't want to finance that shit.
They're hard.
Okay.
What's
Just
funny
good
is,
to clarify.
Marketplaces with thin margins with no upfront capital inventory needs are fundable, though.
Are fundable because it's
A marketplace.
it's not your
Because you're not
inventory. Right.
exactly.
Okay. Let's talk about shit in a box. Good? Not good? Sorry, we're talking about subscription commerce. Physical goods. So Aileen Ong, one of our companies here, who's doing fabulously well and whose economics are awesome, I will disclose publicly, kind of had a hard time with the raise that we were like, shit, this is an awesome business, and we piled into. And she worked her butt off to get that round done. And I'm looking at her economics going like, why the fuck is anybody not like just writing her check on the first meeting? Because it's awesome. So, you know, not that she wants to characterize her business as shit in a box. However, is this a good business or not? Like, I think the logic 2 or 3 years ago was, hey, you know, subscription customers, as long as churn is low, is great because it's predictable revenue.
As long as churn is low. And I
As
think
long
the
as churn is
challenge
low.
is that, I mean, we collectively here have probably seen everything in a box.
Lots of sex, like literally sex.
Now
many
wait a
sex
second.
toys in boxes.
This
And I don't know
This
about
begs
you,
some
but I don't need all of
questions.
that on a weekly basis. So I think that subscription is a feature. It's not a company. It's a way to curate an experience for your customer because you've identified something that they actually need on a repeated basis.
or have forgotten about paying for.
Maybe or have forgotten about paying for it, but that there's something about that experience and that product that makes sense for me to have it in a convenient manner on a regular basis. And you have to earn the right to be in my mailbox once a quarter or once a month. And if you start not being interesting, I will churn. And if you have churn that's, you know, a couple months in, your lifetime value doesn't work. And so then it is shit in a box.
Okay. So Mike,
Yep.
you've funded quite a number of shit in a box businesses.
I have the largest
Rebuttal.
portfolio of shit in a box businesses in the planet. Well, I mean, this would be the difference. Is Dollar Shave Club shit in a box, right?
No.
So what I would say is Dollar Shave Club's a brand, and whether you
It's shit shower shave in a box, actually.
that's it. There was a
Come on,
there was a
that
live
good.
broadcast of
That
colonoscopy
was
this week.
good. I want a little.
It's unbelievable. But
whatever.
I think that what's exciting about that business is that they have excited customers that like the product monthly, but that product could also be in the store. That product could also go into a lot of different areas because it's a strong brand. So I think the point is if you're putting non-branded goods that you don't own in a box and shipping it, that may not be the best business. If you happen to have a subscription product for a branded good where you own and manage that brand and people love that brand, and maybe that brand could exist outside the subscription model, maybe that's better.
So
But
what
wait,
I'm going
can
to
I-
translate what I
wait.
hear you saying is if margin is fat and churn is low, it's a good business.
Well, that's probably generally true for everything.
And you know, frequent,
Right?
Right?
Now what's interesting is
domain
that
parking.
That may be a function of how creative your marketing is.
But wait. I mean, if you think about shaving, it's this routine thing that you do every day, every other day.
Not so much for some of us.
Some of you don't. Yeah, clearly. but it's routine, right? And you consume these things over a period of time, and it's very predictable
Right.
when you need the new box, right? And
Right.
so now, am I going to buy the? We saw a lot of tampons in boxes too, which
We
was
see
an
so
interesting
many.
one. A lot of those.
So many tampons.
Still seeing them. I don't know why. It's not that hard to buy the box.
It's a
tampons.
big market.
But I mean, like when you're in the shower and you run out of shaving cream.
Low
It
churn.
is a big market.
It's a low churn market.
Okay, I know I started this. Let's stop. Let's stop right now.
But I think there's a point to like asking, is the box like fulfilling a necessity or a need that the consumer has that is predictable that they're going to replenish? It's a replenishment business at that point, right? It's so different than like, oh God, not prescriptive, proactive, right? And those businesses have existed for years. We're not just selling them online, right?
Actually, interesting point. So I've been asking this question all day. Video, relevant for commerce? How relevant?
Yeah, I
Important?
think video is extremely relevant for commerce.
You guys have had
I mean, Dollar
tremendous
Shave Club, I
success.
think, is a great example.
Sure. I mean, video as a medium is relevant for commerce. Video as an audience pool is relevant for commerce. Shopping on top. We did an investment with a company called Fuse that does kind of, in essence, shoppable videos, and that's highly relevant for commerce. So I think video as a channel, I mean, if there are people there and they're looking at it, it's going to be relevant for commerce.
So do we feel like that's been recognized by a lot of people in the industry? It feels like, there's still more to be done with video quite a bit for commerce.
It's interesting. YouTube is probably actually like one of the most unsung heroes of commerce.
Absolutely.
I think it's an incredibly powerful channel that people
Is
don't
that because we're
realize.
stupid or because they're stupid?
I know, well, they have a lot of stuff going on. But I think obviously, like, one of the questions is like, will there be a QVC or an HSN of the
Why
of
shouldn't
the
there
web and
be,
mobile,
right?
Like I know Joyous is trying to build something like that, and
Yeah.
we haven't figured that out yet. But it feels
Do
like
you
there's
guys,
an opportunity for
I mean, I
that.
feel like YouTube has been focused on display-based monetization, which is kind of the offline, well, it's not really offline, but the television model. And do you think that they're missing the opportunity to go direct to customer and just focus on commerce-based or at least search-based monetization or some transactional-based monetization for YouTube?
Well, I mean, you got to talk about Google broadly then, right? I mean, Google generally isn't in the business of conversion-based monetization.
What?
Well, they're in their click, their display. They're not caring whether you actually purchase the product.
Okay, but fair enough. At least like click-based monetization.
Sure, and you can buy that through YouTube.
Yeah,
It doesn't work very well.
They haven't really pushed that.
That's true. Well, they haven't. I mean, Google's got the most unbelievable long-term asset in YouTube. Like they could wait.
shit.
They could wait 10 years to monetize that platform.
Fair.
They'd be fine. Like, I mean, it's an unsung hero of commerce because it's an unsung hero of almost every category that exists online.
Do you guys think Susan's going to change kind of strategies for there? Sorry, this is a little off topic, but any crystal ball gazing?
No special insight there.
No. I mean, they changed horses for some reason, right?
Whatever happened will happen slowly.